In a stunning turn of events, a staggering $580 billion vanished from Asian markets overnight. What caused this dramatic shift? A surprising spike in Japan's producer price index. By the end of this video, you'll grasp how this 6.3% PPI print has boxed the Bank of Japan into a corner, and why the global yen carry trade is starting to unravel. We are on the brink of a historic policy shift that could reshape market liquidity throughout 2026. Why has the producer price index suddenly taken center stage? For years, Japan has battled deflation, but now, producer prices have surged to 6.3% year-on-year, far exceeding expectations of 5.5%. This marks the highest level in over 3 years. This situation is not just about rising costs, it's a crucial test for the Bank of Japan's credibility. If they fail to act now, inflation could spiral out of control, and the yen's weakening will continue to diminish Japan's purchasing power on the global stage. The market reaction has been severe. In the wake of the PPI print, the Nikkei 225 tumbled by 1.89%, while South Korea's Kospi plummeted 4.52%. Investors are now pricing in a staggering 93% likelihood of a rate hike at the Bank of Japan's June 15 to 16 meeting. This shift signals an abrupt end to Japan's long-standing easy money era. The rapid pace of this repricing is what triggered the massive $580 billion sell-off across Asia, as traders rushed to mitigate their positions. On social media, traders are expressing extreme caution. Many are warning of potential sudden interventions by the Bank of Japan aimed at punishing short yen speculators. There is a palpable fear that a swift reversal in the US dollar to Japanese yen exchange rate could trigger a dramatic unwinding of global carry trades. One trader articulated it well, stating that this liquidity drain won't be confined to Tokyo, it will reverberate through US tech stocks and even the crypto market as investors scramble for cash to settle their yen-denominated debts. Institutional perspectives are shifting rapidly. Analysts at Daiwa argue that the anticipated June rate hike is not about an overheating economy, but rather driven by credibility risk. They assert that the Bank of Japan cannot afford to appear passive while PPI numbers soar. Concurrently, Reuters highlights that a weak yen paired with a hawkish Federal Reserve is applying unprecedented pressure on the BOJ. To maintain pace with global yield changes, the BOJ must accelerate its tightening measures. A significant historical milestone has just occurred. The 10-year Japanese government bond yield has surpassed the topic's dividend yield for the first time since 2008. This signals a crucial shift in domestic investment strategies. Institutional investors in Japan are beginning to withdraw from equities and redirect their funds into bonds. For the Nikkei, this means that the advantage of high dividend yields relative to bonds is fading. This transition is fueling the equity sell-off as Japan's cost of capital starts to normalize. The yen carry trade serves as a vital source of global liquidity. When investors borrow yen at near-zero rates to invest in assets like Nvidia or Bitcoin, they effectively short the yen. If the BOJ opts for a rate hike, the cost of this trade will rise. A stronger yen would make repaying debt more costly. We're beginning to see early signs of this unwinding impacting U.S. tech sectors. A sudden reversal in the U.S. dollar to Japanese yen exchange rate could result in a violent liquidation of global risk assets, far beyond the confines of the Tokyo stock market. For individual investors, the June 16 decision has become the most crucial event on the horizon. Managing currency risk is no longer a choice, it's essential. Keep a close eye on the 10-year JGB yields. If they keep rising, the pressure on the Nikkei will remain fierce. It's wise to steer clear of aggressive speculative positions in short yen trades, as the risk of punishment interventions from the Ministry of Finance or the BOJ has reached its peak in years. Consider cash and short-term bonds as a temporary refuge. Looking ahead, what can we anticipate? Let's explore 3 AI-driven scenarios regarding the BOJ decision. In our base case, a modest 0.25% hike is announced, stabilizing Japanese yen to US dollar between 145 and 152, while market volatility remains heightened as the carry trade continues its slow unwinding. The bull case envisions a perfectly signaled transition, where the BOJ anchors the yen without crashing the Nikkei, leading to a rebound in domestic demand. Conversely, the bear case presents a tumultuous scenario. A surprise 0.5% hike triggered by PPI data could send US dollar to Japanese yen plummeting toward 140, with the Nikkei testing levels below 35,000 as global margin calls spark a massive sell-off in risk assets. Japan's 6.3% PPI print is truly a watershed moment. Here are the key takeaways. First, a June hike is now 93% priced in. Second, JGB yields have become more appealing than Topic's dividends for the first time since 2008. Lastly, the global carry trade faces extreme risk. Stay tuned for the June 16th decision. It promises to be a volatile week. We want to hear from you. Do you believe the BOJ is acting too late? Don't forget to like and subscribe for more in-depth analysis of the Tokyo markets. See you in our next discussion.